Hello, everyone. Kenneth Hamilton here. We're here to talk about the one beautiful bill. We'll be digging through a lot of information. Very excited to be talking with you. Again, there's nothing more valuable than your time, whether you're watching this live with us or on YouTube. Thank you for being with us. Crazy times we're in. In a few hours, we're getting ready to launch somebody to the moon. Supreme Court is in the middle of debates. And again, with all this news, nothing was made that Congress last night, overnight, unanimously simplified the tax code down to one page. April Fools didn't happen, did not happen. So let's talk about the thousands of pages that the tax code actually is.
Good one,
Uh,
Ken.
so chat's open. Go ahead. We're all monitoring while the other person's speaking. Let's make this as much of a conversation as possible. But next slide. So what we're going to be talking about is really high level overview of what's in the bill, how it could impact you, and our goal is to help you understand the changes to the plan and make sure that we are being proactive about it. It was signed last year, and probably the biggest thing to understand is that a lot of these were extensions of the current law. Several of the rules are new and time limited, but it's important to know what's going to be permanent and what ultimately expires. So we'll label these throughout so you can clearly see which provisions may impact your planning long-term versus short-term. Oh, next slide, bud.
We lost your video, Ken.
Oh, yeah. Some might say that that's an improvement, but okay.
Come on, you have a face for video. You know you
There it
do.
is.
Yes.
So as mentioned, some will be temporary, some will be permanent. And most of those that are expiring are in 2028. So let's dive into some of my screen is all sorts of acting up. One moment. Okay, so yeah, let's dive into the individual tax changes. So for many clients, this is going to preserve a favorable tax environment. However, projections still matter, especially for Roth conversions, investment income, and retirement withdrawals. So we were expecting that the brackets were to sunset this year, but now they have been permanently extended going forward. So the current lower tax brackets from the 2017 will no longer expire. They're going to stay in force. Next.
What when people think about permanent, Ken, what's that usually mean when we're talking about tax changes?
Yeah, my arm's getting tired from all the air quotes. So permanent means as until the next congressional regime changes it, until an actual law gets passed. And right now, not a lot of those are happening. But whenever the next administration and the next House and Senate gets in place, and they actually vote, and all three bodies actually pass it, and somehow doesn't get debated in the courts. But so it's permanent until it's not, basically. And for our planning purposes, that gives us at least a 3-year runway to expect for most of these to be in force. Did that help, Jason?
Yes, thank you.
Perfect. So one of the most important deductions that exists is the standard deduction. You might remember a decade ago where it was really important to keep track of all of your receipts and everything else because you might be doing itemized. There goes my camera again.
No, you're good. Oh, no, we lost you. Now you're
Yep.
back.
Yep. So you might have been doing itemized deductions, but because they've increased the standard deduction, it makes less and less sense. And the other part of that to be thinking about, and I forget if we going to talk about it in this event or the previous tax workshops, is it might, especially for those of you that are charitably inclined, you might not be getting any deductions for those charitable contributions. And most of that is due to the increased size of your standard deduction, is that you aren't exceeding $30,000 of medical expenses and repairs that are deductible, as well as your charitable contributions. But it might make sense to bundle a bunch of those into 1 year to stretch out your donations for the next 3 to 5 years. But again, the standard deduction has now been increased. It has now been permanent. And gentlemen, remind me, is that now tied to CPI, or is it now flat at 31.5 until it's changed again?
I believe it's increasing the
Okay,
CPI.
perfect. Thank you so much. Now, this one's nice for all of our folks that are 65 and older with income below 150,000 as a household. They get an extra $6,000 of a standard deduction. And so what that means is pretty much an extra or $1,500 less in taxes, uh, calling 25%, that they get to keep in their pocket.
Just remember, those are temporary on that one. So that one will go away at the end of 2028.
Thank you. Yep. So those are temporary and they're going to be going away. Thank you, Jason. Now, alternative minimum tax, they are not only have they increased the exemptions, these are also now considered to be permanent. Uh, for those married filing jointly, this is income of total gross income of north of 500,000 to about $1 million. So it's a select few that maybe have very rich income and maybe they had a bunch of deductions that reduced it while the government says not so fast. Let's go ahead and run it through this other calculation and maybe you'll have other taxes that you need to be paying. But again, they've increased that amount of what those exemptions are allowed, and now they're coded to be permanent going forward.
Guys, I think AMT is one of those things that a lot of people have seen those letters. What does AMT mean? Who does it typically affect?
Yeah, it's the alternative minimum tax. It's the households that make substantial income, but through deductions. I think we see this most commonly with a lot of real estate folks that they have a lot of income coming in, but they also have a ton of deductions that they're able to apply as well. And so while there's a gross income of $600,000, they might only be able to report 300 or $250,000 of income. Government says, well, not so fast. Let's go ahead and take a closer look at some of those deductions and maybe the taxes you're paying might be a little bit higher.
It definitely affects those people. I would say it also affects your high income earning professional, right? Like the executives, the business owners, the people who have high incomes coming in, because when they built that AMTN many decades ago, it was designed to be a two tax system: the normal tax system that you follow, and then the AMT tax system to catch people who were deferring income from that end. So they'd run them through both systems, and whichever system was the highest, that's who you had to pay from that end. So AMT's got a real long history of that part. What's interesting about what they did in this bill is, Ken, the original TCJA that they put in place had higher exemption limits than the revised version they just did to us. So they actually brought it down from 1,000,002 and some change for the phase out for a joint family million. I think it was 252,252,000 down to $1 million. And the same thing with individuals, from 626,000 down to 500,000. So they're going to capture a little bit more people than they were capturing before, but that's still a very high threshold. I mean, originally AMT was capturing middle income families to upper middle income families a lot in that net.
Yeah, and the challenge there, especially for our clients who live in areas that are a lot more expensive. I mean, that was sweeping up households where it was a teacher and a firefighter living in the same household, and they'd both been at work for 30 years, right? Because their combined income was pushing the $300,000-400,000 range. And it was causing real problems for people who 300,000-400,000 in rural Minnesota, which is where I'm from, goes a long ways. Some of you out in Palo Alto are going, "Oh my God, you can't buy a cup of coffee for $300,000." So I'm exaggerating, of course,
Yeah.
but you know what we mean.
But have you had it though? I mean, it's
It's
pretty good
great
coffee.
coffee.
It's
Yes,
really
it's
good.
great coffee. So,
So let's talk about how it impacts families. So the first one is another temporary change.
oops,
It
sorry.
is the child tax credit, whopping $200. It was 2,000 previously, but now it's 2,200. And again, every penny counts. The main thing, though, is that the child must have a valid social security number, and this is another temporary one. This is going to roll back in 20 after 2028. Now, again, that 2,000 is inflation adjusted, so as we're all dealing with gas and stuff like that, it very well might be right back at that 2,200 or beyond, depending on exactly how inflation is behaving.
Yeah, and Ken, just a comment on inflation. I double checked it. The question on inflation, what they're using for this stuff is chained CPI, not consumer CPI. So the difference between the two, consumer CPI is how much the goods actually go up in price. Chain CPI is basically if steak goes up in price a lot, someone's going to buy the chicken or maybe the fish if it's less expensive. And so what it's doing is saying, okay, chain CPI, it's going to grow a little slower than some of the headlines you see, but it is still going to grow. So just a little clarification on something that came up earlier. Sorry, go
Perfect.
ahead.
Very nice.
Yeah, yeah. The other thing is that there are now Trump accounts, that what they're calling, and it's for children that are born between 2025 and 2028. There's a deposit that the federal government's going to make once you open the account for $1,000, and you can contribute up to $5,000 a year. And these are after-tax dollars. So think very similar to a Roth or 529. You can use these for education, job training, first home after age 18, or literally anything after 30. Um, it's a modest opportunity to start early savings. And again, these are dollars that are just available. So if this applies to a member in your family, take advantage of it.
Free
And so
money.
what these changes can mean for you, it might mean your refunds might increase. There's going to be additional support for newborn. The qualifications for obtaining child tax credits are still strict, but they're there. And every family's tax situation is different, and we'll tailor your strategy around your needs and make sure we're prepared for what's permanent, but also especially for what's temporary. Uh, Jason loves to say this, so not to steal your thunder, bud, but there's two different tax codes, those that are informed and those that are uninformed. And if we're not staying on top of this every single year, there's likely opportunities that we're missing out. I mean, literally before we got into this, Jason and I were rapping about some different charitable giving strategies, as well as what we're talking about next is some of the QBI deductions that are now available to business owners. So there's always the good news is it's always changing. There's always opportunity. The bad news is it's always changing and there's opportunities. And so you're either in it or you're not. But gentlemen, anything else?
Yeah.
All right.
Hey, Matt, you're up.
Jumping into retiree and senior planning, I'm going to take you through that and then turn it over to Jason for some estate and wealth transfer. So the senior deduction, there was a lot of noise about the senior deduction in terms of how it was eliminating taxes on Social Security and things like that. So the senior deduction is in addition to that standard deduction that Ken talked about, and it can potentially have the impact of lowering your tax rate for your Social Security benefits. However, the formula that gets used to determine the tax rate for your Social Security benefits did not change. So there is still a formula that gets applied, but that $6,000 senior deduction, it's available for those 65 and older. They have less. Most of you have a spouse than $150,000 of joint income, and it phases out above those thresholds. This is temporary, going to go away after 2028. So I mentioned how that additional deduction might impact Social Security taxation. It also could potentially impact how your IRMA is calculated. A lot of people on this call know what IRMA is. For those of you who don't, IRMA is the means testing for Medicare. IRMA does not work like your state income tax or like federal income tax. Those systems are typically progressive tax systems. You pay 10% income tax on the first however many thousand of dollars. You get over 400,000, as an example, you might be paying a higher income tax on the dollars you go over 400,000. That's how a progressive tax system works. Well, with IRMA, it is a cliff system, which means if you go $1 into the next bracket, it is not just that dollar that gets taxed at that rate. Everything, your entire Medicare premium moves up to that rate. So when you're doing tax planning, and we're going to strongly encourage everybody on today's call, if you haven't already done so, reach out to Jason, Ken, or me. Make sure you're taking advantage of our vault where you can upload your tax returns and schedule a time for us to do an analysis of your tax return, because that analysis can help you predict, hey, what is my Medicare actually going to cost next year? Is my Social Security benefit going to change in terms of how it gets taxed? What's the impact there? But again, this is temporary, right? This only goes through 2028. So take advantage of it while you can. You also, with that additional, a married couple, it's an extra $12,000. You may want to take advantage of accelerating a Roth conversion strategy if you're doing that. You may also, especially for those of our clients who retire a little earlier and you're waiting on Social Security to take the biggest possible advantage of the tax benefits that come with Social Security, you might have a strategic withdrawal plan that you're doing where you're pulling money out of those taxable retirement accounts. You might want to accelerate that if you're 65 and older. And of course, this might change timing of RMDs, right? And when I say timing of RMDs, I don't necessarily mean avoiding the RMD, but you maybe want to accelerate the withdrawal pattern that you're using. Don't just do the RMD. Maybe you're going to do a little bit additional other than what's already in there. Okay, so the way deductions affect modified adjusted gross income, and there is a different modified adjusted gross income for Medicare than there is for Social Security. They're two different formulas. The way deductions affect it is it lowers taxable income. And like we said earlier, if you go over that next bracket with IRMA for Medicare, you move right up into the next bracket. Social Security, you'll still have the test that they apply to make sure that it's got a little more gray area than what IRMA has, but you might also then have the net investment income tax eliminated as well, which is a huge kind of unexpected bonus that I was surprised last year didn't see more publicity around, because that's an extra 3.8% on top of everything else, right? On top of those IRMA surcharges, on top of that higher tax rate on your Social Security, on top of your higher income tax rate as well. And that $12,000 for a married couple might be enough to eliminate that net investment income tax. So it's one of those things that, again, and I know I already said it, I'm going to say it one more time. Make sure, if you're not taking advantage of our vault, that you are taking advantage of our vault. If you don't even know what that is, that's okay. Get a hold of me, Jason, or Ken. We will walk you through it. But you can securely upload your tax returns. We can do that analysis and show you what some savings opportunities might be for next year. All right, Jason, estate, and I think that's you. Yeah, estate
Yep,
and wealth transfer.
that's me. Thanks, Matt. So not a whole lot of big changes here. I mean, it made some changes to the amount that you can pass on without estate tax. So it went from the 13 million to the 15 million. They put an index for inflation in there. This really struck the number of people that would be exposed to estate tax down a lot from that end. It's very, country-wise, there's a very small percentage that meet that limit. And that is a permanent thing, like Ken said, until the next Congress decides to do something else with it. So same thing we talked about here. Lifetime gifting. I want to talk about that a little bit because as people have developed large portfolios through habitual habits of savings in their 401k and just general savings in general, what we're finding more and more of is that the growth in the limits with the inflation uplift is not keeping up with the growth in the portfolio. So at some point in time, your portfolio may only be $8 or $10 million, and you're saying, "Oh, I'm fine," they actually end up intersecting because your portfolio is growing two or three, four times faster than the uplift they're giving from that end. So lifetime gifting is becoming important. Gifting to the charities that you care about, gifting to the people that you care about, getting some type of gifting plan in place and using the annual exclusion that they provide, which is the 19,000 per person in 2025, going to raise in 2026. So consider locking in those type of gifting opportunities and using some of your exemption in some cases, right? Married couples, there's very different advanced planning techniques that they can do to use some of the exemption, put it behind a trust, and that trust can grow without the estate tax over the course of time, especially if you have legacy desires, people that you love.
So, Jason, let me ask you a question. So you meet someone who's worth 5 million, 10 million, whatever the number is, and they look at this and they go, well, whatever, I'm fine, right? When you meet those people, how many of them have a big chunk in a retirement plan or an old retirement plan or an old IRA?
Almost all of them. I mean,
Almost
I
all
think
of
we
them.
met one person that didn't fit that, uh, one or two people that didn't fit that criteria. Almost all of them have large amounts in retirement plans that are
So,
ticking time bombs for
yeah.
taxes.
And I know we'll touch on this a little more later in the webinar, but the reason I'm asking is that person looks at this headline, if you will, the 15 million, and I can give away 20 grand a year, basically, all that stuff, and says, I don't have anything to worry about. Could you take a second and just say, hey, if that's you, this is what you need to think about for when you're alive, and this is what you need to think about for when you're gone. I mean, could you just take like 30 seconds and make sure they understand that it's not just estate taxes they need to be thinking about?
Yeah, for sure. I mean, the estate tax is what it is. If you don't ever hit it, that's fine. The bottom line is everyone that has a pre-tax retirement plan is going to struggle with having to take money out of there and being taxed on the money they're taking out. And as you know, being a historian that you are, we're in one of the lowest tax systems we've been in, probably the third lowest system in the history of this country
Mhm.
from that end. So most people that we talk to believe taxes are going to go up. Well, if I have to take money out of my retirement plan and I don't get to choose how much because the government says I have to take 4.5, 5.5, 6.5%, depending on my age, that could get pretty rough when you're taking out 100, 200,000 more than you actually need to do all the things you want to do. And the government's collecting their 25, 30, some people have saved so much, 35% out of what you're distributing, right? So it's a very painful process. And then while you're experiencing all that pain as you're distributing over your lifetime, and then you pass away and you say, hey, well, I want to go to my kids or my nieces, right? Another person from that end. Now they got 10 years to get rid of all of that money. They have to take it out, which just compounds their tax effect going forward. So you
Mhm.
want to talk about a two tax dragon, that's it right there. Not only am I going to get you while you're here, but I'm going to get you when you're gone and make the payment super high so the government can secure their government monies.
Jason, you mentioned this in one of our conversations maybe last week. One of the people that we study closely under, Mr. Ed Slott, what does he talk about regarding IRA dollars and what's the
Yeah,
right
I
amount
love
to
Ed
have?
Slott, man. He's one of the best professionals. He's one of several people that we tutor under that are in that tax space. Um, Ed basically has a methodology that roughly, if you're over $1 million in pre-retirement, you've done it wrong because the only person that's winning now is the government, especially in the tax regime that we're in today. So, to know that and to think about how many people we have met just in the last 3 years that have been over $1 million, right? It's just it's like he says, it's a ticking tax time bomb waiting to go off where the government gets to determine how much tax you pay.
So thanks for elaborating on that, Jason.
Yeah,
All right. So I think we kind of hit on this complacency.
yeah.
The um,
The one thing I
so-
will add to this, Matt, is
Mhm.
that um, there are several states that, in addition to the estate tax that we're talking about federally have their own state inheritance tax.
Hmm.
And you were a product of that when you were in New Jersey,
Yep.
right? Because the state of
Yep.
New Jersey said not only will we let the federal tax you, but we want to tax you also. And the
Absolutely.
limit was a lot lower.
Wait, that's for sure.
And isn't Washington proposing a millionaire tax where if your income it only impacts those if your income's above $1 million? But if that's the case, now you have to pay 10%. Is that, did I read that right?
Yeah, there
I don't
is
know the
some
details,
additional
but there
stuff.
is a
Yeah, I don't,
proposal.
yeah,
You
it's
know,
pretty crazy.
and
So
I'll go back to one of my slides, temporary versus permanent. The only thing we can be really certain is permanent is the next 365 days, what the tax code is for this year. Even then, there's a hint that they might retroactively change. So, you know, your bullet point right there is lulling into complacency is things will change and all they have to do is turn a dial a little bit and that could easily cost you more. So yeah, I'll leave it at that.
this is probably the topic that people miss the most is charitable giving. A, because most of the tax professionals aren't trained in a charitable part of the tax code from that end. So they don't understand it. They don't understand how it works. A lot of people that we meet do have charitable inclinations. Um, like I said, they just don't understand the part of the code. So things like donor advised funds, Ken, you were talking about, hey, the standard deduction is real high now and your charitable gifts don't count, right? Well, a lot of people that we meet that we go through the planning process with, we counsel that stagnate your gifts with your standard deduction, meaning one year you're going to gift real heavy. A donor advised fund can help you with that. So then the donor advised fund can continue to give each year that you're not giving, and then the next year you'll take a standard deduction. So you can do some offsetting to try to save some tax dollars that way. I have yet to meet a person that I've met that understands charitable remainder trust, unless that's the field they're in, and usually I know them as a peer from that end. So, that's a huge ticket to reduce income tax. I shared a story just yesterday with a person that was visiting with me about how we helped a family set up one of these. We did a bridge of about 10 years of income that they weren't going to have because they weren't old enough to get Social Security and they wanted to wait and let that build up because it was so tax efficient for the state they were in. And how we use that tool to not only give them additional income, but also get them a $300,000 deduction that they then used to create more Roth money to have more tax-free money in the future. So these tools, when used appropriately, can be very advantageous for people.
So there's options, right?
Yeah, lots of them. I mean,
I
we haven't
mean,
talked about the testamentary part of that when you put it into your legacy and stuff. So there's a ton of things you can do.
yeah. All right. You're still working. Okay. You're paying your property taxes, right? Talk to us about that, Jason.
Yeah, this is probably one of the things that the legislature hated the most that happened was the SALT deduction got raised to $40,000. So it used to be the 10,000, which would keep you from being able to itemize. Think about people that live in high tax states, New York, California, those higher end tax states where they're paying stuff. Even a property tax in Texas is not cheap
Right.
from that end. This is kind of a big deal because it got them back into itemization where they could say, hey, I can deduct all of the income tax I'm paying to the state of New York or California and the property tax and the sales tax and all that other stuff that happens and get my 40,000 plus the other normal deductions that I have, health and everything else going forward. Um, so, if you're under 500,000, it's great. There also was enough of an issue that they said it's also temporary that they're only
Hmm.
going to let this go, I think, through 2029. And then after that, they're like, nope, we're back to the $10,000 cap, and you're just going to be getting standard deduction so you can pay more tax.
Yeah.
Tips, this is super interesting that they actually allowed tax free on tips and overtime wages for people that meet that requirement, meaning they're usually in the service business from that end from 2025 to 2028. Now, it does have a cap, a phase out, just like everybody else. I think the phase out was $125,000 of income for singles and a little bit higher than that for couples. This auto loan interest thing was very interesting that they'd actually let you deduct the interest, and obviously this is favoring American-made autos in this case on vehicles assembled in the U.S. So an example of that would be it doesn't necessarily have to be an American-made; it has to be assembled in the U.S. So Toyota has actually incorporated plants here, assemble their vehicles here in the U.S. So they might qualify for that part. It's limited, and the phase outs are pretty low for that part, but it'll help a lot of the joint couples that are in lower income thresholds.
Yeah, and if people are curious, this is something that's come up for me a couple times, and Jason and Ken would tell you I'm more of a car guy, so I pay closer attention to this stuff. Um, what they base it on, the way you'll know is look at your VIN, your vehicle identification number, and you'll see that on your insurance card. You'll see that in the dash, under on the inside of your windshield. If your first character of your VIN starts with a one, a four, or a five, that means the car was assembled in the United States, country of origin. Okay. Anything else, anything that's numeric means Canada or New Mexico. Letters mean other places, Japan, Europe, whatever. But yeah, if you've got a one in front of your vehicle, great. Keep in mind, General Motors imports more vehicles into the US than it exports.
Yeah,
So
people don't realize.
keep that in mind. You may have bought that GMC or Chevy or Cadillac or whatever, and it may have been assembled someplace else. So didn't mean to steal your
Good
thunder,
point.
Jason, but that's come up a couple
Oh,
times.
hey, that's a
So
great point. People don't realize that. Hey, Matt, I'm buying a GM. It's American.
nope.
Sorry, it was assembled in
Nope.
Mexico.
The
Right? So
badge is,
you
and that's
right.
about it.
Yeah.
So
QBI deduction made permanent. This is kind of a big deal because the QBI is great for business owners, right? That meet the qualifications from that end. So the 20% deduction of your income. So, you're a business owner, a small business owner, you're making $300,000 a year, you're filing your Schedule C or your 1120S. Well, guess what? You're getting that 20% deduction on that amount. That means 20% comes off the top, right? So when you think about that, 300,000 at 20% is what, $60,000 that you didn't pay tax on? That's not too bad.
so question for you. You have an S corp with two partners. Just without using numbers, how does that work for those three people? Just as an example.
So if it's three partners, they view each partner separately, right? So whatever the phase out is, which I believe was, I think when Ken and I looked at it, it was close to 500,000. So each partner would have the 500,000 before they'd phase out from that end. So when you look at that as a whole, I mean, the business could be doing $1.5 million of net revenues, and you could still participate in that 20%, which last my math, 500,000 at 20% is $100,000 of non-taxable dollars.
Right. On top of a higher standard deduction, on top of, well, it might preclude the standard deduction. Now you're just itemizing everything on top of that, correct?
Yeah, it might at that stage, right? Because remember, that's coming out, so it's not something you're going to report and then take out. It's something that's going to come off the top, and then they're going to start figuring the math from there.
Yeah, so this is where it can get confusing for people who don't study this every day, right? Because what Jason's talking about is what we would call an above the line deduction with this. A lot of people get hung up on the below the line deduction. And the below the line deduction is your adjusted gross income has been calculated. Now here comes this deduction. The ones that are above the line have a much bigger impact because they're lowering the dollars that go into that adjusted gross income calculation.
Yeah,
So just that can get super confusing if you don't deal with it every day. Oh, and this is a big one for business owners. It's a real big one.
huge. Yeah, huge, right? I mean, the fact that they brought this back, because it was the 100% bonus depreciation when it first passed it, takes you. And then it was scaling down from there. They had a schedule to scale down. You will notice there's a big temporary tag on there, right? So they weren't going to allow this to go indefinitely, but it's fantastic for businesses that have equipment, that have stuff like that, because typically you have a lifetime for that equipment, and if the lifetime gets shorter than 7.5 or 15 years, they'll let you scrunch it all up into 1 year, right? Which is a huge ability to kind of control some of your tax as you get the equipment you need for your business on that part. So we buy a copy, fax, print, all that other machine that does all the stuff for us out there. guess what? We can deduct the whole thing.
So I'll bet ChatGPT and OpenAI and companies like this love this.
Oh yeah, the R&D expense. You know, Matt, the funny thing is people don't really use this a lot. We were talking, me and a tax attorney were talking to a client when- Tuesday, Tuesday, about this because she was creating software that helped her business manage better from that end. And she didn't realize that she could actually do a research and development for the cost of creating that software to help her business do what she does, and that the software was actually quite valuable from that end, and she should be putting it in a separate entity for sale on a tax-free basis later.
Hmm.
So, this thing is people don't take advantage of this research and development enough. People honestly do a lot of research and development, and they just don't understand what they're doing.
So know the definition. That's
Yeah,
what you're saying.
absolutely.
Okay. Okay. All right. What should people be talking about? What should they be asking? Like when we do that analysis for everyone, and again, upload your documents. We'll get a time scheduled. We will do that tax analysis. But what are the questions they should be going through with us before they take it to their tax advisor?
Yeah, it should be any improvements they made in their business, right? Any purchases they made, uh, any, like we said earlier, research and development they've been doing around software or anything like that. In their business, engineering firms have a different protocol that they follow, but just kind of understanding, okay, what are the moves that I made and what are the questions, more importantly, that I should be asking my CPA? I tell almost everyone I talk to, the CPA's life is tough. They got 500 plus returns they got to do, and they got a very short window to get them done in. And they do not have time to sit on the thinking rock about your
Hmm.
return and say, "Oh, what could I have done better here to get a better result?" No, they have to move on to the next return.
Yeah. So they have to be reactive. I mean,
Yeah,
they don't have
if
a
they
choice.
they're historians, they're looking in the
Yeah.
past and trying to see what they need to document, right, on these forms. They're not forward typically they're not forward thinkers saying, "Hey, what can I do to make the forms look like this next time?"
Right. Right. All right. Social program changes. Okay. So a lot of this stuff won't apply to a lot of people on today's call, but you might know someone it affects. So Medicaid requirements were accelerated. Originally, those were going to go into place in 2029. They've been moved up to 2026, so this year, which does mean a lot of people could lose Medicaid coverage. Um, if you are in a Medicaid scenario, you'll hear us talk about this quite a bit. Um, you need to make sure you're working with probably an attorney who specializes in Medicaid planning. But if you are thinking, oh, well, Medicaid is going to take care of me if anything happens to me, think again. Okay. It's getting tighter and tighter. And the people that we run into that we know who end up in a Medicaid scenario, the only reason they're there is because they didn't plan for what could happen. That's the only reason they end up in that scenario. There are some people that, hey, birth defect, whatever, those things will happen. Medicaid is going to be a useful tool for some of those people. However, a lot of people, especially older people, they end up having to use Medicaid because they did no other planning before something happened. So, SNAP and Medicare eligibility restrictions. So, parents are only exempt from work requirements if the child's under the age of 7. And from a Medicare standpoint, legal immigrants with decades of tax payments could potentially lose their benefits. So, from a standpoint there, what they're doing is they're tightening up the definition of who can actually be on Medicare. Right? It used to be you had to be a legal resident 5 continuous years, that kind of thing. Well, now it's permanent resident or citizen is what they're looking at. So it tightened it up quite a bit. Um, Prepare for tighter eligibility. Okay. And while some estate and some of the business relief, like what Jason was talking about, may help in some way, a lot of the income-based need, I should say, or income-based aid is actually narrowing. So I'll just say it again. If you're 50 and older, 40 and older, and you're thinking that everything is about just the return of your investment portfolio, and you're not thinking about taxes, which the fact that you're here today means you are, so good job being here. But you're also not thinking about some of the healthcare things that I hate to tell you are coming down the road for you. If you're not thinking about those things now, you need to, because they are going to come for you eventually. So just keep in mind, and programs are getting tighter. They're not getting, looser at all. All right. So we've talked about a lot today, Ken. Oh, this is me still. Sorry. Fiscal impact and political outlook. Okay. It is going to add some debt to the federal government over the next 10 years. The argument in favor of this is that it will increase productivity, it will increase overall incomes for people, which in turn means more tax collections for the federal government. That's really what the argument is in favor of this. I will say, and those of you who know me really well know that I can be a little cynical about politics. I was a little disappointed in the arguments last year, both for and against, because they felt strikingly similar to the previous administration's arguments. They were just flipped. This one was more tax relief focused. That one was more spending focused, right? More money into the economy means more opportunity for people. And we're going to do it by pumping dollars into the economy through government spending. That was the previous administration. This administration, we're going to collect less dollars from people in the economy and businesses in the economy, and we're going to pump money in that way. They're both trying to pump money into the system, right? But what was disappointing was the arguments for were strikingly similar. Hey, it's going to pay for itself. And the arguments against were strikingly similar, which is, oh my gosh, it's going to add a whole bunch to debt. So where does that leave us? The truth, not unfortunately, but the truth is probably somewhere in the middle, right? Could it lead to productivity increases? Sure. Could it lead to more debt? Sure. Is it going to be an extreme one way or the other? Probably not. Probably not. The key is it's temporary. Even though it says it's permanent, all it takes is a new administration, a new Congress, and they rewrite the law. That's all it takes. So with that, I'll turn it over to Ken.
Okay, so what can we do? Step one is give us your tax returns. Allow us to analyze, see what things look like as your income increases. We're able to adjust things for inflation and everything beyond. Make sure we're evaluating your deductions, credits, estate plan, but I'll go one step further, your time. We had this household we're working with. They have a business effectively where they were raising goats. And for whatever reason, we noticed that their CPA was considering it a form of passive income that was coming on. But Jason, how many hours was this individual spending on their goats?
Yeah, more than a normal person going to work, more than 40 hours.
Yeah, and so just by reclassifying one box being checked, turned it into active income and is now going to result in a six-figure tax return from the federal government. Who wouldn't want that? But you might be having a hobby. You might be providing services to a friend, church, this or that. And because of it, it might be qualify as a business with the proper documentation structure and things like that, and can mean real dollars to you. I'll go back to what I said at the beginning of the conversation. There's two tax codes, the informed and the uninformed. So one, knowing where your income's coming from, knowing what deductions, credits are available, what your estate plan actually needs to be. And let's move to this side of the ledger. Let's become informed and figure out what all is available to you. So let's review your plan. Are we taking full advantage of all the opportunities that are available today? Because tomorrow is not guaranteed. Are we protected from future risks if they do decide to increase the RMD percentage? If they do further shrink down the time frame your kids can liquidate those inherited assets? Are we above that $2 million mark of IRA assets? Again, we've been talking about it with you, but maybe it's time to be a little bit more aggressive while we have more runway. But step one is let's just schedule time for a review. And so let's stay informed, stay proactive. Tax laws are always changing, and being proactive, avoid scrambling later. Everybody, we did it in 45 minutes. I can't believe it. So
Yay.
congratulations.
We try
Um,
really hard not to wear you out on these webinars. We really try. So,
yeah. So thank you for your time. Enjoy y'all's lunch, breakfast, whatever you're having, and be careful out there. It is still April Fool's Day.